Hello and welcome to this Diwali special. Over the next 1 hour here on Smart Markets, we'll talk to the country's finest money managers to help construct a portfolio for you this Samvat. The year gone by, remember, has delivered a 10% return. That's on stocks. And the projections for the year ahead, well, let's just say are very lofty to say the least.
Well, that's correct. So we've picked up 4 market participants for you. ICICI Prudential's Manish Gunwani will talk about the macro framework within which the markets or the stocks will actually perform. Mahesh Patil of Birla Sunlife is here to talk to us about how exactly can an average investor generate alpha. Vinay Khattar of Edelweiss Securities and Emkay Global's Krishna Karwa will talk about the HNI view and also, of course, some cracker stock ideas. So let's get it started then. Manish, let me start the discussion with you. With Diwali round the corner, the festival of investments today, Dhanteras, how does the outlook for equities in particular look? Is it brightened up for the next Samvat?
Yeah, we definitely think so. So if you look at where we've come from, essentially you had a phase between 2009 to 12 where in response to a global slowdown, there was immense stimulus both on fiscal and monetary side from the policymakers. Now that kind of overheated the economy and pushed current account deficit and inflation beyond reasonable levels. So today we are at a point where we are recovering from that phase. We've obviously improved the macro variables a lot. Unfortunately, I think what has happened is while India has done a lot of hard work, the global tailwind has been entirely missing from this cycle. So if probably that was there, we would have seen even growth coming back by now. But unfortunately, due to huge levels of debt, demographic and other structural issues, the global stimulus is not there at all, which means that we're taking probably longer versus some previous cycles to reach a stage where the private sector is able to deleverage and contribute to the capex. So the way we are looking at it right now is you have a very good setup for a recovery, and there is a certain part of the economy which is recovering already. But we think probably a full-blown capex-driven recovery is 1 or 2 years away.
Okay, so capex-driven recovery is elusive, at least for the next couple of years. Mahesh, let's talk about the case for Indian equities as we head into the new Samvat. Is it getting stronger? Are the building blocks in place?
Yeah, I think as we look forward into the next Samvat year, I think the building blocks for the equity markets to do well are getting in place. I mean, last 2-3 years, we have seen that while the markets have kind of rallied a bit, but the fundamentals have been lagging behind. But I think as we stand today and look forward, a lot of the drivers for the market are in place. I mean, to name a few, like we had after 2 back-to-back poor monsoons, this year the monsoon looks to be normal and the sowing has been good. So I think as the harvesting happens and the money flows to the hands of the rural people, we should see the consumption start to pick up. Interest rates, which were high until a few years back, have come up dramatically in the last 1 year or so, and that impact on the bottom line should also be felt more in the coming year. And overall, I think we feel that the government, in terms of the policy action, I think what we have seen in the last 9 months has seen significant policy actions even on the legislative side, which will help to drive the underlying economic growth, be it the GST, which recently was concluded, and the on the banking sector reforms which we have seen. So all that I think will structurally pave a way for recovering the economy.
Right. Vinay, how are you assessing the commitment levels of some of the big HNI clients, some marquee investors, the names of whom we keep seeing in the bulk deal data? How are they approaching the market? Are they allocating more and more from here on, or are they moving some significant amount of money from their premium real estate or gold portfolios in favor of equities? How's the flow from that pocket which you service closely?
So you're absolutely right. We are clearly seeing traction building up as far as equity allocations are concerned. You rightly pointed out that gold is going nowhere, real estate is pretty much stagnant. So broadly, equity allocation per se is going up. And the surprising thing is that the valuations are not causing a huge amount of discomfort. People are willing to come and bet on mid caps even at relatively lofty valuations. And then there is a very strong expectation that earnings growth on mid cap, small cap could be very, very robust over next couple of years, which is causing significant allocation in these particular segments. If you were to look at just the mid cap returns, in 6 months, mid cap, small cap indices have given returns close to 20 to 25%, while Nifty returns have been just about 10%. In last 3 months, Nifty has given just 2% return, while most of the mid cap and small cap indices have given close to 10% plus kind of returns. So you find that a lot of HNI allocation is clearly shifting towards mid cap and small cap, and equity is clearly the flavor of the month.
Krishna, the house of Emkay specializes in small and mid-cap, picks, and clearly that's one section of the market that's given very handsome returns, some 23% in the somewhat gone by. Compare that to the measly 10 that the Nifty has delivered. Are you worried, though, that valuations on that end of the market are a little expensive? Is that really the case, you think?
See, if you look back in the last 1 year, if you look at the broad market, yes, the markets have moved up by almost 10-12% on a Nifty basis. But within that, if you look at the small cap, mid cap space, that has done phenomenally well in terms of the stock price improvements, etc. And the primary reason for this is the improving profitability of many of these companies. There is a good amount of liquidity, domestic liquidity, which is coming into the market, and global liquidity has also played its role. Now, if you ask me the prognosis, what is the way forward from here, I think the stocks have broadly done well, and at current levels, it's like price to perfection, which means that what we are seeing now is going to be a kind of a consolidation phase. Earnings now have to catch up. We are very confident that in the next 12 to 18 months, there should be a reasonably good improvement in earnings based on the improving domestic economic fundamentals, based on the government spending as far as pay commission, etc. is concerned, and a strong monsoon will also play its part. So going forward, yes, there could be kind of a consolidation which may happen in various stocks, but from a longer term perspective, we are very, very positive on the market.
Right. Mahesh, at the start of the show, we promised our viewers that we would give them ideas on how their portfolio should be constructed. Let's talk about the potential of stocks on a portfolio level that, say, an average 35-year-old should have. And, we're saying 35 because the fact is that one of India's key points is its demographic dividend, and that's really the youth. At a portfolio level, how much alpha do you think can be created?
So if you look at historically, as you said, the market return has more or less been in line with the longer term earnings growth trend, and that earnings growth almost has tracked the nominal GDP growth, slightly higher than that because of better productivity and improvement over there. So if you assume that, we assume that the nominal GDP growth going forward should be somewhere around 11% or so, and if you go back in the last 5 years, the earnings growth trajectory has been well below that kind of a trend line growth. It's been around 8% or so. With the drivers for earnings growth coming in place as the volume growth picks up, as capacity utilization improves, as operating leverage kicks in, we expect the earnings growth over the next 3 years or so should be slightly above the nominal GDP growth, could be around 13 to 15% or in the mid-teens or so. That's the kind of earnings growth which one can expect. And with market valuations are trading at slightly above the long-term average. So one can't really assume any kind of a re-rating, but earnings growth is something which the market delivers I think that's the return which I think long-term investors can expect from equity. And in Indian context, we've seen that the active fund managers have been able to generate a decent alpha over the benchmark. In the last 3 years, it's been much higher. But even if you look at the long term, around 3 to 4% kind of an outperformance is something which a actively managed fund can deliver, especially a multi-cap kind of a fund. Then I think investor can potentially look at returns of somewhere around 17 to 80% CAGR over the next 2 to 3 years.
Right. Vinay, if we were to talk about some of us who are very regular index watchers as well, up till now we were talking about portfolio selection, what areas to look at, but some of us are compulsive index watchers and that gives them comfort about where their portfolio is heading. What would you tell them on Sensex or a Nifty basis by next Samvat, next Diwali time? Where do you see that head?
The way one should look at is that indices normally are not representative of money making potential of the market. As I just gave you this data in terms of performance of mid-cap indices versus large-cap indices, there is a very, very significant difference. Overall, once the earning begins to come in, you see Nifty's and Sensex companies, almost 60 to 65% of earnings are international demand led in one form or the other. Either you've got companies which are operating or you've got significant businesses coming from international geographies, and that part of the segment will still take time, some more time, though we are seeing trends beginning to change, exports beginning to pick up, but that part of the segment will still take time to pick up. Domestic domestic demand is what will be a strong trend going forward. So can mid-cap and small-cap indices give you very, very strong performance? Clearly. As far as Nifty and Sensex are concerned, as I just mentioned, our sense is that you could see new highs sooner than later, and earnings will continue to surprise us on the positive side from H2 of the current financial year.
Well, that's pretty comforting to know. Let's talk about specifics once again. Krishna, last Samvat or the Samvat gone by, home improvement names, auto ancillary stocks, agrochemicals, these are some of the areas you guys at Emkay had done some serious research on, and the stocks also rewarded the shareholders. What are you working on now? Which are the pockets you are researching closely, which could have potential significant returns in the new Samvat?
Yes, thank you very much for acknowledging the effort that we have put in some of these spaces, and markets have recognized that. And it is a continuous process to deliver good investment ideas for our investors. But what I would like to share with the investors over here is that you have to be patient enough, which is that hold on to these stocks for at least a few years to be able to reap the benefits. Now, coming to sectors where I believe that there could be opportunities, one is where you will have to look at wherever valuations are reasonable vis-a-vis the growth opportunity. And there I feel that many of the auto ancillaries, their growth prospects have improved tremendously on the light of the strong domestic growth in two-wheelers, four-wheelers, etc. Many of these companies have reached a critical size and scale in terms of their absolute numbers, and they are also benefiting from an improving, or rather many of these global majors have set up shop in India, and so they are becoming part of the global theme also. So auto ancillaries as a space offers a lot of opportunities in terms of good companies with good pedigree and which can get scaled up big time. So that's one segment that we are positive currently.
Manish, let's talk about the road ahead, and that's clearly, fraught with a fair amount of uncertainty. What are the big events that will be on your radar as far as the next 1 year goes? I'm sure it's the US presidential election, UP elections. What else will you be watching closely?
So one is obviously it's going to be a mix of global and local events. So starting with US presidential election, I think the important implication there is its influence on Fed's decisions, as well as how the currency market would treat that election. I think while obviously domestic flows have been consistent and strong, we have to obviously be aware that a large part of our market is driven by foreign flows, and there is a strong correlation between dollar strength and emerging market, and India kind of follows the emerging market basket. So if the dollar starts strengthening due to an implication from the US presidential election that Fed will be more hawkish in future, I think that could have a sobering effect on the Indian market. It could lead to some kind of correction. Then we come to the domestic politics. Obviously, again, you have a series of election next year, not only UP but Gujarat and Punjab as well. So those are going to be important.
Okay, Mahesh, let's also talk about something else that the market is really looking ahead for, and that is earnings recovery. So far, what we've seen from the second quarter, things look pretty patchy for corporate India. Do you suspect that it's going to be a while before we see things turn around?
Yeah, so the earnings recovery has been elusive. Markets always expected at the beginning of the year that earnings growth will be around 15 or even 20% kind of growth on a one-year basis, and the reality has been much lower. But at least today, as we stand, I think the confidence of earnings recovery looks much stronger because, as I mentioned earlier, the ingredients for that are already in place. So I think we should see pick up in the consumption in the second half on the back of decent monsoons. The government public infrastructure spending, especially in roads, railways, power T&D, will have a multiplier effect in the economy, and which should also help a broader recovery. And cutting interest rates are real. We've seen that the corporate borrowing cost has come down by around 200 basis points in the last 2 years. So that will help drive down profit growth. So I think the confidence, and obviously the base effect is very favorable. So from a second half, as we move into the second half of this fiscal year, the base is very favorable, especially for sectors like metals, private sector banks, even pharmaceuticals, which saw a significant decline last year. So partly because of base effect in the near term, but more structurally, as the economy gains a bit momentum, we should see recovery kind of sustaining at least for the next 2 to 3 years.
Manish, talking of or taking that point a little further, in the last cycle, we saw that the aggregate earnings on the large cap front peaked out around 25%. This cycle, how far can earnings go? We're just barely starting from here on, but what do you see the script play out as?
So our sense is, again, going back to the previous framework, that while we think the recovery is definitely on, unfortunately the private sector deleveraging and global growth are fairly big headwinds. So we would think that the earnings recovery will be relatively gradual over the previous cycle, but at the same time we think broadly we are at the bottom of earnings. So next 2 years you should get a much better earnings growth than last 3 to 4 years. So I think the capacity utilization today in a lot of industries is obviously very low, and there will be a constraint in supply because of poor economics. So it is the usual business cycle playing out where the supply of capacity will be less than the demand, and therefore you will see operating leverage play out. I think pace lot will depend also on how global growth pans out. If the global growth today recovers back on a mean reversion basis, and a lot of emerging markets today have very high real rates. So if they are able to cut rates and stimulate the economy and the global growth recovers, I think we'll get a faster earnings growth.
Krishna, how are the HNIs and family offices you guys service positioned right now? Are they sitting on cash? Are they completely committed and deployed in the market? Because lately we've observed that some of these players have become so large that even the market has been able to absorb, because of participants like these, any kind of volatility which arises from FIS selling. So falls are being cushioned. What are your observations?
Ajay, you have hit it on the head. What you can see, the changes which have happened in the HNI family office segment is that they have become so big and so process oriented. Now all these investors, they have their own team of research analysts, maybe 3, 4, 5, 6, depending on the size of the team. and they also are meeting management regularly, and whatever ideas we share with them, they also are critically evaluating them. So what has happened is that whenever they decide to invest in any sector or any stock on the small cap, mid cap segment, the depth of their understanding is far, far superior than what it used to be earlier. Now, that helps in a very good way that if there are a few quarters where the stock has disappointed, they don't panic because they have understood the fundamentals of the opportunity and are willing to probably average out rather than throwing in the towel as used to happen earlier in the absence of poor information. So, this is one big change which has happened amongst the family offices, and it is a change for the good.
Mahesh, let's bring the focus back to, the economics and really whether the macros are indeed on the mend or not. From an economic standpoint, is this going to be a 2013 to 2019, cycle? Because the last cycle from an economic standpoint was 2003 to 2008. How are you seeing this cycle being different from the last time?
So this cycle is, we have seen it's not been a kind of a one-way secular move. We have seen ups and downs. After 13 we saw a pickup in the economy, but things really faltered because of policy inaction. Interest rates went up, inflation was higher, and then we had the global slowdown also. So I think compared to the earlier cycle from 2003 to 2007, when we had a huge tailwind from the global side, I think that's missing at this point in time. Global economy is going to remain weak. Some of the large economies are going to struggle. So on that backdrop, I think you won't have the tailwind for the growth to really be that strong. But I think the domestic economy, there are some levers for that to improve. So I think given that kind of a scenario, I think you would see kind of a moderate increase in the broader economy, and there will be always ups and downs. Probably from a market perspective, I think the volatility because of global factors, I think something which will be there. There are a lot of concerns still which are there on the global front, which could lead to short-term volatility or correction in the markets. So investors should really be taking that in the stride. The markets will bounce back if the domestic growth remains strong, which we expect should look better. But I think volatility would be there in the market, and those corrections, I think one should not fear if the underlying fundamentals are getting in place, and that can be looked as buying opportunities.
Okay, so the underlying fundamentals, Mahesh says, are very much going to be in place. Manish, to respond to that, how do you see this script play out in that context for some of the large caps over the next quarter, say till next Diwali? Which are the sectors you think that will benefit from this recovery that will be captured in real economic growth that Mahesh was talking about?
So I think given our overall framework of a recovery happening, even if gradually, we do tend to be overweight the most cyclical sectors right now from a long-term perspective. So I think it is sectors like financials, utilities, capital goods, autos, which look more appealing to us at this point of time versus defensive sectors like IT and FMCG.
Right, and now we've come to the end of the show, and of course the most exciting part to discuss some specific stock ideas. Krishna, let's start with you. Some of the names which you could share with us, which you guys have researched very closely from the house of Emkay, names which can give some reasonable returns for the new Samvat.
So there is one stock which we are very bullish on is Gujarat Heavy Chemicals, GHCL. It's a very strong company in terms of the return ratios that they are generating, and the valuations are very reasonable for a 25% plus kind of an ROE business. They are currently quoting at around 7-8 times March 17 earnings. We believe that there is a significant scope for re-rating in this company, because soda ash, which is their main business, is not as cyclical as it is people think it to be. There is a lot of logistics issues involved in this, and with this company has around 25% market share, and we believe that investors in this company should deliver good returns over a period of time. So that is one stock. One of the other stocks which I believe should be a key beneficiary of GST implementation, and which should do well over a period of time, is Kajaria Ceramics. They are the market leader. They have huge pricing power, and the margins that they enjoy are phenomenal. And valuations, it has got re-rated substantially, but we believe in the next 3-4 years, as the real estate industry picks up, this home material business will do. This company will continue to do well and should deliver good returns.
Vinay, what about you? From Edelweiss desks, what are the cracker stocks you are recommending your clients?
It's an infrastructure company. It owns 4 road projects, and there's a reasonable chance that over next 6 to 12 months, those projects could get sold. Once those projects get sold, then the company could get significant amount of cash, which will also take away debt. So net debt position in the company could just become practically zero, and the stock could then multiply from the current level. So JMC project could be a very, very interesting bet with a 1 to 2 year view based on this singular event, that in case the management decides to sell the bought projects. So that's one. The second one that we like a lot is Indian Terrain Apparel. Indian Terrain makes men's apparel, and it's been a brand which is in vogue, and we believe that the entire apparel industry is going to see significant uptick in demand over the next 3 to 4 years. Once you do a comparison with China, at what Chinese were at per capita income and where we are today, the discretionary spend goes up very significantly as the economy does well and per capita incomes begin to go up. India will see that trend over the next 5 to 7 years very, very strongly. So all apparel companies, especially Aditya Birla Fashion and Indian Terrain, could be very interesting bets, and Indian Terrain clearly is our pick in this particular space.
All right, gentlemen, with that, we'll say thank you to each one of you: Manish Gunwani of ICICI Pru, Mahesh Patil of Birla Sunlife, Vinay Khattar of Edelweiss, and Krishna Kumar Karwa of Emkay Global Financial. Each one of you, thanks so much, and season's greetings to you from Team ET Now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.